Ever wondered why derivatives are such a hot topic in the world of finance? Well, let's dive into it. Derivatives are essentially financial instruments, kind of like a bet on the future. Their value is derived from underlying assets, which can be anything from stocks, bonds, commodities, currencies, interest rates, or even other derivatives. They're like the backstage crew of the financial world, unseen but orchestrating a lot of the action. Now, there are various types of derivatives, but the most common ones you'll hear about are futures and options. Futures are agreements to buy or sell an asset at a fixed price in the future, while options give you the right, but not the obligation, to do so. People use derivatives for two main reasons: to hedge risk, like an insurance policy, or for speculation, betting on future price movements. Imagine buying an insurance policy for your car. That's a real-life derivative. Now, isn't that fascinating? Stick around as we delve deeper into this intriguing world. So, how exactly do these derivatives work? Let's break it down and let's keep it simple. Imagine for a moment you're a farmer who grows wheat. It's spring, and you've just planted your crops. Now you have to wait a few months until harvest time to sell your wheat. But here's the catch. You don't know what the price of wheat will be in the future. It could be higher, it could be lower. This uncertainty in financial terms is called price risk. On the other side, imagine you're a bread maker. You need wheat to make your bread. Just like our farmer, you're faced with the same problem. You don't know how much wheat will cost by the time you need it. This uncertainty could impact your ability to make and sell bread at a predictable price. Enter derivatives, specifically a type of derivative called a futures contract. In our scenario, the farmer and the bread maker could agree today on a price to trade wheat in the future. This agreement is the futures contract. The farmer now knows the price at which he can sell his wheat, and the bread maker knows how much he'll have to pay for it. This contract, this derivative, helps both parties manage their price risk. Now remember, a derivative is a financial instrument whose value is derived from an underlying asset. In our example, the underlying asset is wheat, and the value of the futures contract is derived from the agreed-upon price of the wheat. And here's the thing about derivatives. They're not just for farmers and bread makers. They're used by individuals, companies, and governments around the world to manage risk and potentially enhance profits. They can be based on a variety of underlying assets like stocks, bonds, commodities, currencies, interest rates, and even other derivatives. So in essence, a derivative is like a security blanket, protecting you from potential financial downfalls. Still struggling to see how derivatives fit into daily life? Let's dive into some more tangible examples. Take insurance policies, for instance. They're a form of derivative as they derive their value from an underlying asset. If you own a car, you've likely purchased a policy to protect against potential damages. The insurance company calculates your premium based on the risk they're taking, a derivative of your driving record, the car's value, and other factors. Another example is airline fuel hedging. Airlines often use derivatives to lock in fuel prices for the future. This helps them manage the risk of fluctuating fuel costs. They pay a fixed price now for fuel they'll use later, which derives its value from the current market price. These examples illustrate how derivatives help manage risk and provide financial security. From your car insurance to the price you pay for bread, derivatives play a significant role in our day-to-day lives. Derivatives may seem complex, but as we've seen, they're an essential part of our financial ecosystem. Let's quickly recap. Derivatives are financial instruments that get their value from an underlying asset. This could be anything from stocks and bonds to commodities like gold or oil. They serve two main purposes. Firstly, they can be used to manage risk. For example, a farmer might use derivatives to lock in a future price for their crops, protecting them from price fluctuations. Secondly, they can be used for speculation, allowing investors to profit from changes in the value of the underlying asset. But remember, while derivatives can be powerful tools, they also come with their own risks and complexities. It's essential to understand these before diving in. If you're intrigued by the world of finance and want to keep learning, make sure to subscribe to the channel. Stay tuned for more enlightening videos on finance.